Silver just snapped the entire market awake in a way that nobody can ignore anymore. In a matter of just a few weeks, we went from quiet and completely ignored to people asking, how is this even real? We witnessed a fast, aggressive run higher, followed by a sharp, sudden drop, and then, as if nothing happened at all, price snapped right back toward the highs. That kind of price behavior is absolutely not normal, and it's telling you something critically important about what's happening beneath the surface. And today I'm going to break down exactly what's driving this unusual action, why the next few months could get extremely violent in terms of price swings, and what most people will completely miss until it's far too late to position intelligently. Because here's the setup that changes everything. When a market escapes an old reality and breaks free from years of suppression, it stops moving like it used to. Old trading rules die fast. The easy technical indicators start lying to you. And the people waiting patiently for a comfortable pullback end up watching price leave without them while they sit frozen. Before we jump deep into the analysis, I need to give you a quick but important heads up. I'm running an active campaign to eliminate copycat channels and protect original work on this platform. If you genuinely get value from these breakdowns, I need you to support me right now. Hit the subscribe button and drop a comment that says OG John AG so I can see who the real supporters are. And yes, YouTube statistics show that most of you watching right now aren't subscribed. If you want more of this kind of no-fluff honest analysis, fix that today. Also, because this campaign is live and building momentum, I opened a dedicated WhatsApp channel specifically for the core audience. I'll post daily market updates there, share short clips before they go public, and add my personal notes when something important shifts in real time. The link is in the description below. Subscribe there too, and you'll stay consistently ahead of the crowd without living on price charts all day. One more thing before we begin. If you're watching this on a phone, pause right now and save this video. The next major swing will happen fast, and you'll want a clear reference point handy when it does. Now here's exactly what we're covering in this video. First, what actually happened in silver recently and why the recent surge, dip, and snapback matters structurally. Then, the one critical relationship that can flip silver from steady to absolutely feral almost overnight. After that, we'll connect the dots to gold, the bond market, and the policy response that can pour fuel directly on precious metals. Then we'll talk about mining stocks, why they still look dramatically mispriced, and what could trigger a sudden violent re-rating. Finally, we'll touch on oil and the wider commodity complex, because the quiet market is often the one that ambushes everyone. And somewhere in the middle, I'm going to ask you a specific question that might fundamentally change how you position for the next 6 months. So stay with me, because the answer is not what the crowd wants to hear. Let's start with the obvious. Silver is acting like it's been released from a cage after years of confinement. The classic pattern for most markets is simple and predictable. Run up, cool off for weeks, drift sideways aimlessly, reset sentiment, and then choose a clear direction. But silver lately? It sprints violently, slips hard, and snaps back like a spring-loaded trap. That's why the normal retail crowd keeps getting baited repeatedly. They see a fast move and scream top. Then they see a fast pullback and scream collapse. And then silver does the most disrespectful thing possible. It completely erases the pullback. So what fundamentally changed? The big idea is this. Silver isn't just a commodity like copper or wheat. It's also money. And it's surfing two completely different waves at the same time. One wave is monetary. Confidence erosion, currency stress, the growing hunger for hard assets, the fear of unsustainable debt, the fear of policy mistakes, and the need for something that can't be printed or diluted. The second wave is industrial. Technology expansion, electrification, data centers, solar installations, electronics manufacturing, and the reality that demand can grow faster than supply for years before price finally reacts violently. Most analysts stare only at the industrial story. They talk about solar panels, chips, and demand charts like that's the whole movie. But when silver flips into a true monetary moment, the character changes completely. It doesn't crawl higher politely. It doesn't trend gently. It lunges. Now, there's a specific trigger that tends to spark those explosive lunges. How silver behaves relative to gold. People love talking about the ratio, but I prefer thinking of it as a relationship. What percentage is silver compared to gold? Over long history, that percentage stretches and snaps. When silver is extremely cheap relative to gold, it's like a rubber band pulled too far. It can stay stretched longer than you expect, until suddenly it can't. And when it finally breaks through a major ceiling, it doesn't tiptoe. It accelerates. We've seen versions of this before in history. Back in the late 1970s into 1980, Silver was already in a bull trend, but then it went wild. Not up a bit, wild. In a short window, it multiplied. Then in 2010 into 2011, the same idea played out. Silver had been rising, frustrating bulls with slow progress, and then it suddenly sprinted and tagged the top of its old long-term range. Here's the key point. Those explosions didn't start because somebody woke up and decided silver was cool. They started because a ceiling in the silver versus gold relationship cracked. And once it cracked, price behavior changed. Now apply that idea to today. If silver has been stuck under a multi-year ceiling versus gold, and it finally punches through, you shouldn't expect a calm grind higher. You should expect a new reality. And in a new reality, corrections can shrink from months to days. That's not hype. That's market structure. Think about other markets that lived in long boredom and then snapped. Copper spent decades trapped in an old box. Then it broke out and in a short time repriced into a completely different world. Lead did something similar later. Those moves weren't polite. They were compressed, sharp, and shocking. Because when a market spends too long in the wrong place, the catch-up doesn't come as a slow apology. It comes like a slap. So the question is, was silver trapped for too long? For decades, silver kept returning to the same upper boundary. Meanwhile, other assets, metals, commodities, even gold itself, kept establishing new highs over time. Gold's history is a reminder that old highs are not sacred. They are just markers. In prior bull cycles, gold moved multiples from its lows to its peaks. If you study those cycles, you see a pattern. Once a major uptrend takes hold, the move can be bigger than the public expects, and it can last longer than the public's patience. That matters because silver is attached to gold psychologically and structurally. If gold is building into another major phase, silver doesn't need a miracle to go further. It needs permission, and that permission often arrives through that relationship shift. Now, I'm not here to sell you fantasy numbers. I'm here to explain how markets behave when ceilings come off. When the crowd says it's overbought, you need to ask overbought compared to what reality? Because if the reality changed, the indicator didn't get the memo. This is why the usual technical playbook can become dangerous. People see an oscillator screaming, and they think it guarantees a reversal. But in prior silver explosions, overbought conditions can stick for a long time while price keeps climbing. In other words, the indicator can keep you safe from profit and safe from the move. So how do you handle that without becoming reckless? You separate time horizons. If you're holding physical metal or long-term positions, you don't try to outsmart every swing. You respect volatility, but you don't let it shake you out of a structural shift. If you're trading leverage, options, short-term bets, that's different. Then timing matters. Then a midpoint correction can hurt you even if the bigger trend is right. And yes, even in explosive runs, midpoint corrections can show up. Not the end, a pause, a shake, a moment designed to convince you the story is finished right before it continues. This brings us to the next important idea, round numbers. Markets love to play games near big, clean levels. Not because the universe cares, but because humans do. Round numbers attract attention, orders, fear, and ego. They become battlefields. That's why you can see stalls, fake-outs, and sharp flushes at levels that look obvious. So if silver pushes toward a major psychological milestone, it wouldn't be surprising to see a nasty dip along the way. But here's the trap. People confuse dip with death. They expect the old world to return. And when it doesn't, they're left begging for entry while price is already running again. Here's the question I promised. If silver drops 10 to 15% in a matter of days, would you panic or would you see it as the market clearing weak hands before the next leg? Tell me in the comments honestly, and tell me what you're watching more right now. Silver itself or silver relative to gold. Now let's zoom out to the bigger stage because this isn't only about silver. When the financial system starts wobbling, it doesn't wobble politely. There are quiet areas that can suddenly become loud, and one of those areas is long-term government debt. Most people don't wake up thinking about bond futures. They wake up thinking about tech stocks and headlines. But long-term debt is enormous. And when confidence in that market gets shaky, policymakers tend to respond with more intervention, more liquidity, more support. And whether you call it support or not, it usually means more creation of currency units over time. And what benefits when currency units are diluted? Hard assets. That's why monetary metals can move even when the stock market looks fine. The myth that metals must fall if stocks fall is lazy. Sometimes metals dip with everything during a sudden liquidation event, but history shows they can recover fast and then outperform while risk assets continue to struggle. The correlation is not a law of physics, it's a mood swing. Now let's talk miners because this is where things get interesting. Miners are not the metal, They're leveraged businesses tied to the metal. They can underperform for long stretches and then catch up violently when the market finally believes the move is real. And one way to see this is by comparing miners to gold. Over long periods, mining indexes have traded within ranges relative to gold. In some eras, miners held a healthy portion of gold's value. In other eras, especially after major crashes or long bear markets, miners became historically cheap relative to gold, almost like the market priced them as if they were permanently broken. When that relative value hits extreme lows, you often get a setup. If gold remains strong, miners don't need perfection. They need a spark, a shift in sentiment, a wave of capital rotation, a change in earnings optics. And earnings optics matter, even if you hate fundamentals. Because when the metal price rises while production costs don't rise as fast, margins expand. And when margins expand, headlines follow. Then the same people who ignored the sector start buying because the numbers look good. It's backward, but that's how crowds operate. Now, I promised one more twist. Oil. Oil has been the quiet outcast. While other assets moved, oil spent time feeling heavy. And when a market feels heavy for too long, it can become dangerously interesting, because cheap doesn't ring a bell until it does. Oil can look depressed relative to other assets, relative to gold, relative to the stock market, and sometimes even relative to its own history. That doesn't mean it must rise tomorrow. It means it becomes a candidate for a surprise move. And surprise moves often happen without a clean headline. Sometimes the narrative says more supply, weaker demand, it's going lower, and then the market makes one more ugly flush, what traders call a vortex low, where everyone feels confirmed, and then it turns up anyway because the selling is exhausted. If oil does that, it can change the entire commodity conversation. So where does this leave us? Silver is behaving like a market that has shifted regimes. The relationship to gold is the tell. The speed of recoveries is the tell. The shrinking of corrections from months to days is the tell. And the constant attempts by the crowd to force today's behavior into yesterday's box is the tell. If you treat this like a normal advance, you'll be tempted to sell too early, hesitate too long, and chase too late. If you treat this like a structural shift, you'll respect volatility without letting it bully you. So do this for me. Tell me in the comments which one you think is the bigger driver right now, monetary fear or industrial demand. And second question, if you could only pick one, would you rather own the metal or the miners? And remember, if you're successful in business, investing, career, anything, share one win in the comments. It might be the exact thing someone else needs to hear today. Now, final reminder. Support the campaign against copycats. Subscribe and comment, OG John AG. Join the WhatsApp channel so you don't miss daily updates. And if you want more of these deep dives with high-stakes implications, hit the like button and share this with one person who keeps ignoring silver like it's a side character.